Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, August 22nd, and then we'll see how things look for Wednesday, August 23rd. I'm recording a little bit different. Instead of using a headset, I'm trying to just use some regular old earbuds with a microphone to see if that helps to improve the sound quality at all, since I can't do any configuring of the sound after I record. Well, it was a pretty sleepy day again, not necessarily a surprise for the month of August. We're still dealing with summer and vacations and a market that's not quite sure what it wants to do right now. We're still looking negative, but at the same time, are we starting to form a base after we come up out of a bottom? We can go through and look at the charts, try to analyze things, see where we come out with that, and then what conclusions we can ultimately reach with where we're at right now. But I'll tell you on my end, it really hasn't changed. We didn't see that much of a move, but some of our charts are improving where other charts are showing continued weakness. Please be aware that I am planning a course in September, a free online course. How I'm thinking of doing this is I plan on at least testing out the idea of streaming on YouTube and Rumble, which I've done before, but I haven't done both at the same time. And because of where I'm situated these days, I can never really depend on the internet access. Not that it's not good, but when I use like a VPN and things like that, sometimes they throttle things down. And then there's issues with the laptop that I'll be using to do this course, which I have some power issues with. Okay, you take all that together. I plan on using a stream to both YouTube and Rumble, but I'll also have Zoom as a backup. So that's kind of what I'm going with right now. I haven't actually set the date yet. I'm still waiting to hear a little bit more feedback on what about Labor Day that's thrown right in there. Do you guys open to that? Not open to that? Maybe I do it on Labor Day, the full length class, and then I do it a week later when it's not Labor Day, and then do the other 1, 2, 3 hour class after that. I will be covering my approach to technical analysis. You might find that interesting and probably a little bit different than what you've heard before. Some basic strategies as well as support and resistance. All right, let's go back and talk about what happened. We had a higher open. We got up to R1 at 44.18, but unfortunately that set the high for the day. It seems interesting how the daily pivot is becoming pivotal. There, how's that for a play on words? After we set that high, prices then fell down to the unchanged level and we found support at the daily pivot at 43.89. We chopped between the unchanged level and the daily pivot. We closed just slightly below the daily pivot. We were down 0.28%, so it was a down day, but not significantly down. And volume continues to be below average. We are negative overall. I'll go through some charts to show you where I come out on that. It's all about inflation, interest rates, growth concerns, and what is Chairperson Powell going to say on Friday? Some comments that we can make. The S&P continues to battle the 4,400 level. For a while, we were battling 4,500. It looked like we were going to get down to 4,300. Well, right now we're at 4,400. Bank stocks were weak after S&P. Now, we look at the S&P 500, but there's also Standard & Poor's, the company, and they're also a credit rating agency. They downgraded the ratings of multiple banks, and the reason for this is they have concerns about funding risks from rising rates because they make money when they loan money out, and the standards are really being tightened for who they're lending money to. And because of that, they may experience not as much profits. So their profits may weaken. Home builders, though, continue to be strong, which is interesting because the real estate sector is really having a lot of trouble. Growth did outperform value. Now, with the large caps, growth was up slightly, but for the rest of the market, growth was down for the small caps and mid caps, but down less than value. This is part of that potential base that could be being built right now. We're still working with this current scenario, which has a little contradiction in it. In the US, we're dealing with the idea that the stronger than expected economic reports are causing concerns in the market, so the Fed will need to keep rates higher for longer. We've known that for a while. What's the variable here is they might have to raise rates again, and that's putting the market really on edge. At the same time, we're concerned about global weakness because of some economic reports coming out of China showing that they're having some real problems with their economy and they're trying to stimulate things. On a short-term basis, our list has gotten a little bit shorter with the oversold indications or extreme negative. We have the CCI 20 as well as the stochastics. On an intermediate term basis, we also have the S&P 500 McClellan oscillator. It's still giving us that extreme negative reading, and the PMO studies. And I have charts of all of these to show you. This to me is positive. This is an indicator that I personally really like. Yeah, it can cause some serious drawdowns at times because it might go against the signal that it's generating. I don't use it by itself, but the parabolic SAR, it had been negative. It's still negative on the weekly chart. But when we go back over to the daily chart, it has now turned positive, and that could be rather significant. The dollar was up and interest rates were mixed. We had the 10-year down a little, 10-year was up a little bit, and they were mixed across the board, but we're keeping a close eye on the different interest rates. We still have our yield curves that remain inverted, and we're still neutral as far as sentiment. We ticked up to 47 where we had been at 46. Our trend is still negative. The ADX is still weakening. This has not changed. We haven't had enough of a move yet to really change that, either in the short or intermediate term. But in the intermediate term, we're below the moving average, suggesting a weakening trend, even though it's trying to turn up. Our bias, I've switched over to mixed because we had kind of an up day on Monday, kind of a down day on Tuesday. The market's really indecisive right now. Volume is really dropping off, and I'm keeping our momentum at mixed to negative. The economic reports came out. We only had existing home sales. They were down 2.2% on a month-over-month basis. Annually, that works out to 4.07 million units, less than the 4.15 million units they had expected. Last time, we had 4.16 million as the annual rate. Sales were down 16.6% from the same period a year ago. And again, why is home construction doing so well and the other areas of real estate still showing some weakness? Kind of interesting. Here is the existing home sales showing how they are declining. Overall, we had been seeing a nice little tick up here, but lately some more weakness. This is one of these charts, and if you've been watching the videos for very long, I'm a little mixed on using these charts. When you take one chart and then use a chart from before and plot that on top, okay, I get what you're trying to do, and history may not always repeat itself, but it often rhymes. And so, yeah, we can use this as a guide, but to base your decisions on this, it's like the Stock Traders Almanac statistics. I really like that, and I think they're very useful, but I don't make decisions based on that. But other people, they do. And sometimes that can work to your benefit, sometimes not to your benefit. I like to take a lot of different things and use them together. Okay, looking here at the VIX, where the blue line is the VIX for 1990 and taking the average to 2022. Now, this is the average, so you're going to get some kind of skewed results here. And then comparing the red line with the VIX of what we've been doing, if we go with the average, as we work our way through August and into September, we tend to see a real rise in the VIX, and that means stocks are going down. Is that going to happen this time? I don't know. Can we look at this and at least tuck that away as part of our information gathering? Of course, and that's what I'm trying to do with this right here. Also, forward earnings, we're still looking rosy there. This is a chart I meant to show yesterday. And as long as this line keeps going up, whether it's justified or not, this is what the market uses to justify buying stocks. And the more they buy, the more prices go up. And now, this is the other concern. This is a Bloomberg composite or aggregate of sovereign yields. And I think they spelled sovereign wrong at the top here. But What this measures is it's the US bonds, the German bonds, the UK bonds, the Japanese bonds, and puts them all into one big aggregate chart like this. And we're seeing that overall rates are going up. Now, there's been some articles out there saying that maybe we're shifting more to a higher interest rate environment. I've been pointing that out for about a month, especially in the weekly videos. I take a long-term look at the 10-year yield where we're making a series of lower highs and lower lows. Now we're starting to go back up. And it was Chris Schiavocco from Schiavocco Capital that really pointed this out. And I've kind of used that as part of my analysis process as well. But we just might be going more into this environment or climate where we see higher interest rates, kind of more back to what they used to be, not necessarily what we've been seeing the last, well, especially the last maybe 10 years since the great financial crisis. But really, if you go back to 1980, we've seen a downward trend in interest rates. Maybe it's going to start to go up again. That's just a new reality that we have to deal with if that's what's developing. All right, let's look at the intraday chart where we had a higher open. We set the high right after the open and then came down to the unchanged level. This acted as some support for a while. We broke through it, and wouldn't you know, we came down to the daily pivot. If you remember yesterday's video, from Tuesday through Thursday, actually Tuesday through Friday last week, we couldn't get above the daily pivot, and it was acting as overhead resistance. Well, so far on Monday and Tuesday, the daily pivot has been acting as support. Now, how long this is going to continue, I don't know. It's just something that we're observing for right now. We did close just a little bit below the daily pivot, but that's an interesting thing to key on right now, especially leading up to Chairperson Powell's speech on Friday. This is also positive and could be part of the overall base that we're building to potentially form a bottom. Where when we were coming down, you see the red line was above the blue line. That means the value was outperforming growth, even though they were both suffering. Well, and then we started going down, down, down. Well, so far this week, we saw a little bit of a bounce up late last week with growth outperforming value, but now it's really starting to separate a little bit. This is an intraday chart. It's a 10-minute intraday chart, and I watch this during the day. And if we're really going down, and this blue line is on top, I'm like, okay, we might see a little bit of a bounce here. As we were going down, if the red line was on top, I'm like, okay, we might see some more weakness here. So this can give us some clues as to the intraday action. And even though I don't day trade, I don't teach day trading, I don't even condone day trading. And I know that may go against some of you folks that listen to this video, and that's for you. That's great. We still like to study what happens inside of each day to try to get some clues, because then that bleeds over into the bigger picture. Here's the growth versus value ratio. Also, we are doing okay here. We're above the unchanged level, meaning growth outperformed value. And we've been seeing a bit of a bounce since late last week after we had been going sideways. This could be part of building a base. Then we look at the VIX, where it ticked down just a little bit on the line chart and the bar chart, even though we had a slight down day. The VIX of the VIX shows that volatility has been decreasing as the market's kind of going to sleep these days. Now it could wake up at any time. This is one thing that negative when we've been going up. Look at this. We're starting to come back down. Have we spiked right now? If that follows through as being a spike, this could also give some really good support for the S&P to go higher. Here's a longer term look at that same chart where we climbed up above this red line and now we're starting to come back down. So this is another thing that we are really keeping an eye on. But longer term, we have been declining. We're starting to turn back up. But if we start to see the equity put call ratio go back up, then this is probably going to continue to go up. If we see a fall, like we might be starting to see, then this should be able to resume its downtrend. And I hope I explained that okay. This is a warning sign, though. We're still below a declining moving average with accumulation distribution. This is measuring what's the smart money doing. Well, a lot of them tend to be on vacation, and if they're doing anything, they are currently selling. The mass index, we're not at a signal yet, and I was actually incorrect yesterday. The third signal that we look at here, I explained that wrong. The first part of the signal is when we go above the red dash line. All right. Then the second part of the signal is when we go above the blue line. And then we drop below the blue line. The third signal is when we drop below the red dash line again. That's when we're looking for a change in trend. Doesn't mean it's always going to happen, but this indicator sometimes can be very helpful for us and to us. Here's the condition of our trend where we're still below the moving average with the intermediate term chart. We're still declining, showing a weakening trend, but we're still above 20, showing that we are in fact trending. The red line is on top, even though it's declining. So we would default to the negative. Here's the short term where we're above the moving average. Now we're starting to flatten out a little bit. So this could suggest in the short term, a trend is trying to get going here, but not quite really moving yet. We would still default to the negative because the red line is on top and declining. The daily chart. As we watch this play out a little bit, we can kind of see this in a little bigger picture where we came down to this previous low, which also was a previous high, which would be a good place for the market to turn around and go back in the other direction. We just need to see more confirmation than what we're seeing. On the bottom, you see where volume is still below average. The CCI 20 is still extreme negative. The 14 period has dropped off. It's no longer extreme, but this one is. And our stochastics, we're no longer extreme in the short term or the intermediate term, but now we're starting to get more extreme in the long term, and we're still declining. The Swenlin trading oscillator, this sometimes can be a leading indicator for us. We had a down day. Well, we see based on price and volume, we're starting to turn back up. Sometimes this indicator leads us astray. Other times it does reinforce what we see after we see the turn up here, meaning that we might see some kind of a bounce from this. But overall, this indicator is still negative because it's below zero. Here's the big change that I'm seeing. The dot is now underneath for the parabolic SAR system. It picked it up really quite quickly when we were going down, and now that we're seeing a change, that could end up being positive. What I was talking about with the drawdowns is, let me try to find one. Okay, right here, back in May, where we started to go positive and we shot up, and then boom, we came right down. Now, if you use stop losses, if you're like, okay, I'm seeing a profit here and now I'm seeing a loss or I'm back to break even, you're freaking out at this point, where this chart is still telling you, go long, go long, go long. But that can really wreak havoc on your emotions. So yes, I like this indicator a lot, but I don't use it in isolation. The slope oscillator, trying to turn back up a little bit, but it's still declining and we're getting to an extreme negative reading. This could end up being positive if we see some improvement with this oscillator. We're also still declining and dropping below zero with the MACD. That's negative until proven otherwise. We're still above the 100 period moving average. We're still below the 50 and 20-day moving averages. We're kind of right in between right now. The S&P 500 McClellan oscillator was pretty much sideways after it bounced up on Monday, but we're still extreme negative. The Chaikin money flow, it ticked down just a little bit, but the red line, the moving average, is still showing some improvement. The PMO study, we're still extreme negative with the percent of PMOs that are rising, but we are turning back up. We're still declining with the buy signals, and we continue to decline with the PMOs that are above zero. And with the buy signals, we're also extreme negative. The itchy and scratchy cloud, which I sometimes call this, are we finding some support in here? It's kind of a big area, but this is just lining up with some other areas that we're seeing on different charts. The MACD, this is a little more concerning. We're dropping below the moving average with our MACD on the weekly chart. That is negative, but if we start to see a recovery coming in here, it doesn't mean that can't recover, but we're just seeing that this is more negative at the current time. We're still seeing a nice little bounce up when we compare growth versus value for the S&P 500. We want to see more follow through with this. The Dow is still hanging into support here. We're coming down to the S1 level, and that is holding up, but we're still below the 50-period moving average. Our NASDAQ 100, we're trying to roll over a little bit with the PPO momentum oscillator, but it hasn't crossed over yet. The small caps are still below their 200-day moving average. That's also kind of negative. When we look at the Russell 2000 small caps, we're still extreme negative with the RSI. So far, the 200-day moving average is holding, but we're still declining with our MACD. The mid caps also still above their 200-day moving average, still below their still above. Did I say above? Still above their 200-day moving average, but still below their 50-period moving average. And we might run into some resistance if we come back up to this S1 level. Bonds, actually, we dropped a little bit with yield. I was incorrect on that. 10-year was down, where I think the shorter maturities were up. But this is still a pretty high level overall. We're not really seeing this decrease after we have been really running up with yields. I didn't show this yesterday, but this kind of ties into a chart I did talk about, which I'm also going to show today. This is the ratio between riskier bonds and more conservative bonds. When this is going up, folks are favoring more riskier bonds, which could be higher risk companies as well as junk bonds. So this is suggesting that folks have more confidence. If they were starting to get more defensive, they would be getting out of riskier bonds and getting into more conservative bonds like government bonds, which are considered to be very safe. This is the chart that I showed yesterday, showing how the longer term maturity is actually outperforming the shorter term. So if we thought the Fed was done raising rates, this chart would be going up. Well, we're kind of undecided right now, and it's looking a little more likely like they might end up raising rates, so this chart is going down. This is another one that I usually show every day. This is the ratio between the 1 to 3 month T-bill, which is pretty much cash, and the 3 to 7 year bond. When this is going up, that means there's uncertainty about interest rates. When I first started using this chart, we were going down, and we actually saw a death cross in this ratio, and it looked like, okay, things are getting better. Maybe we're getting close to interest rates being raised. How's that for a sentence? But we've seen a shift, and we've seen a golden cross with this ratio as it's going back up. So this is a bit concerning and just feeding in more to the uncertainty about what's going to happen with interest rates. I also showed this yesterday, the intermediate term corporate bond ETF. These are companies, and some of these companies might be riskier. Well, they're still outperforming the more safe treasury bonds. And so this is suggesting that we might be uncertain about interest rates, but the bond market is more confident about the economy going forward. Longer term with the PPO studies, we're rolling over just a little bit with the long term. We're declining with the intermediate term, but we're still positive. We're trying to bounce back up in the short term, but we're still below zero. We're also keeping an eye on the S&P 500 weekly chart. We're below this resistance line right now, wondering if that's going to produce a longer term negative issue that the market has to deal with, seeing that same basic thing with the NASDAQ 100. It would be more positive if both of these indexes could get back up to this resistance line and actually break through it. Looking at Tom Bowley, where the third worst calendar month of the year is August, and we're right there right now. Energy tends to not be hot where it's been performing well. Tech tends to be hot where it's been underperforming. Getting more into the latter part of the month, which based on his research suggests that we might see weakness. Now, we have other historical research that contradicts this. And then he is also saying that from May to August is when we see growth outperforming value. We're kind of seeing that. We want to see more follow through. We want to see more of a trend before we embrace that as what's really happening. So what's our outlook for Wednesday? We are getting some earnings reports. We've got NVIDIA coming out. Is that Wednesday? I think before the open. And that's probably going to have a real impact, and everybody's going to be talking about it. The markets are really anticipating Chair Powell's speech on Friday at Jackson Hole. The technicals are negative. I didn't change this for right now. We're still negative. And right now, are we just working off being oversold, or are we forming a bottom? And as we stay at this level, are we building more of a base? We will be getting the weekly MBA mortgage applications index, the S&P Global U.S. Manufacturing. That's one PMI, and then we'll get a services PMI as well. And these are the preliminary reports. These top two are not big market movers. New home sales, it depends on if it's real crazy or not. So we don't have any real influential economic reports coming out. We're keeping an eye on geopolitical events. But for the markets, it's about inflation, interest rates, growth concerns, and what's Chair Powell going to say? Here's the updated economic calendar showing what's coming out on Wednesday. We will be getting durable goods on Thursday. That's kind of influential. And then the speech on Friday. The Stock Traders Almanac statistics. We're more neutral to positive with the Dow, where we're neutral to negative with the S&P and NASDAQ. So we're kind of around that 50-50 point for the day historically. We are still in the week after options expiration, where we tend to be up 66.7% of the time and down 33.33% of the time. Here's our pre-election cycle, where we're in the third year now. We're still wondering if we're going to get kind of a bounce, which historically is what has happened. Then we're keeping an eye on the NASDAQ, wondering if it's ever going to bottom out and start to go back up, even though some things are improving. We're looking at the S&P. We are going up with the green line. The green line is the pre-election after midterm bear, which is what happened. And so that's why we really focus on this green line here, which may suggest we might get some kind of a bounce. We're just not really seeing that. Is the market really going to react positively to what Chairperson Powell says, and they're just waiting for that? Now, a year ago, the market was really screaming higher, and then he talked and it tanked. Is it going to be the opposite this year? We don't know at this point. We will be on the 17th trading day of the month, and I also marked it over here where we're beyond this pre-election cycle positivity, and we're coming up to the 17th day now where we kind of are positive, kind of are negative. So our scenarios, we're going more with the down one. Our technicals are still negative. We want to be proven wrong with this negative idea as we ask the question, are we just working off being oversold before we get set to go lower? Are we forming a base, which will eventually turn into a bottom? It's hard to go with the up one right now because that means we would be front running what our charts are saying, and that can be dangerous. You might be able to go with the short term sideways trend because of how our ADX is playing out. It's still below 20, but we're still in a trending environment with the intermediate term trend. Even though that's a weakening trend, it's a negative trend, but it's still above 20. The warning signs, and this is probably getting ready to go away here pretty soon, but we're still dealing with this. We saw in late July, early August, a convergence of these short-term bearish signals that was pushing the market much lower. Longer-term trend signals, we're still below those trend lines, so that may be signaling that we're at a top, but that's quite long-term. Seasonally and historically, August is not a very strong month, but we're supposed to be in a good time during a pre-election year. Our S&P 500 oscillators are negative, as well as the NASDAQ 100. The VIX, even though it ticked down on a down day, which is kind of strange, it's been climbing for the most part overall. The equity put call ratio, it formed a spike, and will it continue to decline? And then I forgot to add the other. All of the major indexes that we follow are below their 50-period moving averages. The cumulative new highs, new lows are continuing to show weakness. We're still above the 2007 yield that we were getting on the 3-month. And that's right before we had the great financial crisis. And I've been seeing some articles here and there thinking, okay, we're going to fall off a cliff and the economy is going to fall apart. The banking sector is going to lead us into another financial crisis. And that very well may happen. We just have to take this one day at a time and see how it plays out. S&P 500 growth is weakening, but it is showing some strength, and it's trying to resume that uptrend. The vortex is still negative, and we're dealing with earnings season with NVIDIA. That's going to be the big topic. We still have longer-term positive seasonality and setups that are in the background. The special K daily chart is still positive. The weekly chart is still negative. The equity put call ratio, it's positive and has been turning up. We're waiting to see if it can turn back down. The S&P is still above that downtrend channel upper line. We're still in a risk-on posture longer term, but we're seeing more of a risk-off posture shorter term. The S&P continues to outperform utilities, and the staples to S&P 500 ratio is declining. Both of these together often give good support to the S&P. The Russell and small cap index, as well as the mid caps, have generated recent golden crosses, and we're kind of keeping an eye on the 200-day moving average for the Russell. That's kind of a significant level. Small and mid cap growth continues to be positive. The financial sector, even though it's been getting creamed pretty much lately, it still generated a recent golden cross. The parabolic SAR daily chart has turned positive. Personally, I think that's kind of important. And we're wondering, is there a convergence of signals coming together suggesting that we may be forming a bottom? So our conclusion, we're negative, and right now we're still kind of going with this idea that we're just working off being oversold, but we're also wondering, are we forming a bottom? In the short term, we're still negative and working off some of those extreme negative signals, and we're doing the same thing right now in the intermediate term where we're still positive in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.